Good afternoon, ladies and gentlemen. My name is Don Wright. I'm Head of Client Services at Henderson Rowe, and it's my pleasure to welcome you to our third virtual investor lunch. I'm joined today by Dr. Jason Hsu, founder and chief investment officer of our parent company, Rayliant Global Advisors. Good afternoon to you, Jason. I trust all's well on the enterprise.
Always well here.
Excellent. Well, like Star Trek, I should point out that this event is being recorded. And so by joining us today, you consent to that. I'm sure we're all tired of using the prefix virtual. And I speak for the whole Henderson Rowe team when I say that we can't wait to host a refreshingly real, non-virtual lunch where the only support bubbles are in the champagne and your choice is red or white rather than Pfizer or Oxford. The finance industry loves coming up with new technical terms and abstruse language. And in 2021, due to the army of retail traders that congregate on the trade tipping forum Wall Street Bets on the website Reddit, we've had to learn a strange new vocabulary. I'll quickly run through some of the key terms so that we're all fluent in this new dialect. We'll start with an easy one. A stock going to the moon is pretty self-explanatory. To have diamond hands means you refuse to sell a security despite a huge fall in price. The opposite of that is if you have paper hands, where you sell at the first sign of a loss. If you YOLO a trade, you're happy to risk a significant part of your portfolio on one stock, as you only live once. J. Powell's money printer going brrr is quite advanced terminology. That refers to Federal Reserve Chairman Jerome Powell printing more money and injecting further stimulus into the economy. Thankfully, we've got Jason here to explain what the language of internet speculators means for us as investors. I'd like to quickly run through the agenda and some housekeeping for today's event. Our charity speaker today is Lady Asta of HEVA. As well as being the mother of my colleague Charlie, Liz is president of the National Autism Society, an organisation that does incredible work in supporting the 700,000 people in the UK who are on the autism spectrum. Then Jason will give us his thoughts on investment opportunities for 2021, the good, the bad and the bubbly. And then afterwards, he'll be answering questions that we've sourced from our clients. As before, we've taken the precaution of muting all of you today to avoid the background noise of popping champagne corks. But if you'd like to continue the discussion with Jason, please get in touch with your investment manager and they'll gladly set up a call. As before, we'll finish just before 3 o'clock. But before I play our charity video, I'm afraid I've got some sad news to share. Unfortunately, today there is one less chair around our round table as our dear friend and colleague, Patrick Donovan, passed away earlier this month. He'd been fighting cancer from the spring onwards of last year, but he stayed positive throughout, despite the months of difficult treatment that he endured. He joined the company back in 2003 and was affectionately known as the father of the firm. I joined in 2005, and so I feel incredibly fortunate that I got to work alongside him for such a long time. It's a great loss to the Henderson Rowe family, and our thoughts and prayers are with his wife Laura and his son Ned. His focus last year was the same as ever, to work very hard. He was always the first in the office in the morning, to look after his clients and to provide wisdom and guidance to his colleagues. And to provide that wisdom and guidance with a good deal of humour, colourful language and cigarette smoke. One of the few redeeming features of working from home last year was getting to watch Paddy light up a cigarette on a Zoom call. Not many people can get away with that, but Paddy could. He really was one of a kind. So let's raise a glass to Patrick, and without further ado, I'll play Lady Asta and the National Autism Society's video.
Autism is a lifelong disability which affects how people, like me, communicate and interact with the world. There are about 700,000 adults and children on the autism spectrum in the UK. And like everyone, each autistic person has their own strengths and challenges. But all of us have difficulties with communicating and interacting with other people. This could mean not speaking at all, needing longer to process information or not understanding facial expressions. We also engage in repetitive behaviour, doing or thinking the same thing over and over. This is sometimes for fun, and sometimes to help deal with our anxiety. People on the autism spectrum can also find unexpected changes, however small, very distressing. And then there is sensory overload, where noise, smells, touch, and bright lights become very painful and overwhelming. All these challenges can make the world feel very scary and hard to understand, and sometimes send us into physical and emotional meltdowns or shutdowns. It is very important that autistic people get help from an early age. But life can become very difficult if children or adults don't get the right support or understanding. Autistic children are 3 times more likely to be excluded from school. Only 1 in 6 autistic people in the UK have a full-time job. And over a third of autistic adults have reported serious mental health problems. The National Autistic Society is the UK's leading charity for autistic people. Since 1962, we have been changing society's attitudes and transforming individuals' lives. We want to create a society that works for autistic adults and children, and with your help, we can.
Good morning, everyone. My name is Liz Astor, and I'm the mother of Olivia, a 28-year-old with autism, dyspraxia, and a learning disability. For the past year, there has been a great deal in the press and media about the detrimental effects of COVID-19 on mental health, particularly for those who are already struggling. And it's the mental health of people with autism that I'd like to address this morning. There are over 700,000 people in the UK with autism. Most of them already suffer extremely high levels of anxiety, which with help they can generally manage to keep under control with the daily routine, which makes them feel safe and secure. Unfortunately, the virus has thrown all that out of the window and has had an unexpected and incredibly challenging impact on them and their families and carers. My own daughter has suffered agonies, not knowing when she can come home from her care home or even do her own food shopping. This has resulted in displays of anger, tears, frustration and depression, and endless miserable texts and phone calls, all to me, who can only offer comfort but no answers. But this is how you can help. The NES run a parent-to-parent programme which trains volunteers to make calls to desperate parents and carers, helping them resolve a wide variety of issues, first by listening and understanding, and then by offering advice and comfort. But like all charities during the pandemic, opportunities to raise funds for this vital service have been annihilated. The NAS urgently need funds to cover costs for volunteers' expenses, the service coordinators, and management fees and recruitment costs. Last year, between August and October alone, there was an increase of 169% of parents calling for parent-to-parent service. 365 families called, but tragically, 100 calls were left unanswered due to lack of funds. So please help the NAS today to give funds to the parent-to-parent programme, and by doing so, help parents and carers to help those who cannot help themselves. You will not only be saving the mental health of many, but believe me, you will also be saving lives.
Thank you, Liz, for sharing such a personal story there and for all the good that you and the NAS do. If you'd like to find out more about the NAS and how you can help, please do get in touch with us. And now, Jason, over to you. The floor is yours.
Thanks, Tom. Well, first of all, let me thank and welcome everyone for joining me today. Well, I'd like to talk about 2020 and 2021. And of course, you can't really talk about the market today without thinking about whether we are in a bubble or whether this is a new paradigm shift. A lot of old school managers would like to tell you it's been in a bubble, and this is why it's been hard for a managed portfolio to outperform individual investors. Now, is that truth, or is that just old school people talking sour grape talks? Well, instead of giving you a lecture on the state of the economy, I think we can best understand the economy today by going through a few actual live examples. So let me start. Now, you can't talk about the markets today without talking about Tesla, a very controversial topic, because some love it and some people absolutely hate it. So let me give you some facts that you might already know. The total number of cars delivered by Tesla in 2020 declined by 20%. Now you might say, well, that's due to COVID and it's expected. The total market share also shrunk as more manufacturers have come into the EV market with their own flagship offering. As a result, revenue actually declined more than the delivery. So revenue declined by 34% in the US. What is surprising and perhaps less well known is that Tesla is now also rated one of the least reliable cars by J.D. Powers. So this is an issue of a new automaker coming into that market, right? It does take skill and experience over time to produce reliable vehicles. What's even more surprising is Tesla is actually one of the worst rated ESG companies. So how does that work, right? It's an EV company. Isn't that all about green? So you might be surprised the amount of energy consumed for manufacturing a Tesla is rather high. But that also Tesla sells its carbon credit to other polluters. It's actually the biggest part of its revenue driver. So it isn't actually helping to reduce our carbon footprint as it sells away these carbon pollution rights. And of course, batteries are actually quite toxic to manufacture and to process and dispose of when they run their natural life. On other dimensions, such as social, I guess there's been a number of dispute around labor practices. And on governance, we all know that Tesla doesn't really have a board and essentially is a one-man show where shareholders actually have little control over how the company is managed, and the CEO actually simultaneously multitask at 3 other companies. Of course, recently, the big news that came out of Tesla is instead of reinvesting heavily into research and development and building more capacity, it has decided to actually put $1.5 billion, which is more than its entire research budget, into Bitcoin. So this is like a listed company in the UK deciding to take a significant amount of its total capital available, its capital reserve, and go speculate on a few speculative penny stocks. That, unfortunately, was met by the market with yet another round of price appreciation, at least until recently. So all told, in the last year or so, Tesla went from split adjusted $150 to $900. So a 6x increase in the stock price. And that leads you to a market capitalization of nearly $1 trillion, which is larger than the top 9 automakers combined, while producing only 1% of the cars that they produce. Which then, of course, begs the question, is Tesla valued sensibly? Probably not as an automaker, but hey, you could think of it as maybe a Bitcoin play. You could think of it as the future of autonomous driving. However you want to think about it, you certainly can't think about it as a automaker, which is what it's currently classified as. If you think Tesla is crazy, there is Tesla of China, a firm that you may not have been aware of, NIO, N-I-O. This is a company that also makes EV, but just sells it in China. It's one of the biggest competitors to Tesla in China. For every car it sells, it loses $100,000. A year ago, it was a near bankrupt company trading at $1 a share. Today, it is a company still near bankruptcy, but trading at $66 a share. So a market capitalization of around $60 billion. And the price gone up 60 times. So it's done 10 times better than Tesla has, while at the same time losing about $44 a share. So conclude how you will. whether this gives you a sense of bubbly market. Well, let me move on to the next example and help you understand more about the market psychology and a term that Dom didn't share with you, but is certainly all the rage. SPAC, a special purpose acquisition vehicle. So if you want to think of a SPAC, it is the latest and greatest way to make money. Now, up until more recently, the best way to make money was to come up with a disruptive technology, raise some capital, build it sufficiently, and then list it on the public market. But a more genius way has arisen. So essentially what a SPAC is you raise a pool of capital. Let's say you raise $200 million from friends and family. You take that pool of capital, and instead of having a business plan and working on a business plan, you list a pool of cash on the stock exchange. So this is literally taking $200 million, list the $200 million on the stock exchange. The genius trick here is you also sell a story that you're going to take that $200 million and go buy the next Tesla, and voila, create value. That might sound a little crazy, but all of a sudden, with a good story, the listed pool of $200 million, where you've done no work, maybe some Excel, maybe some PowerPoints, is now worth $1.2 billion. Right? You can make cash more valuable than cash by giving it a good story. You think I'm kidding, but recently, a SPAC called Churchill raised $2.5 billion in cash based on a very pretty PowerPoint. I must say it was incredibly beautiful. Listed that $2.5 billion of cash on the New York Stock Exchange and instantly fetch a valuation of $15 billion, right? Your cash has now become 6 times more than other people's cash. All based on a rumor that they're going to buy the next Tesla called Lucid Motor. The transaction has not consummated, but since the announcement of details of what the consummated deal might look like, unfortunately, the stock has declined and has fallen from $15 billion down to $7 billion. But still, it's $2.5 billion of cash, coolly valued at 3 times. Now we talk about something that everyone has been talking about, and perhaps some of you might even try to buy some Bitcoins. And you, I wonder if you had good success, because it's actually quite complicated. I haven't figured out how to do so myself. So what is Bitcoin? Well, at the root of Bitcoin is a rational fear that too much money printing by the Fed Reserve, by central banks around the world, is weakening currency like the dollar, like the British pound. That is a rational fear, and we'll speak about that during our Q&A. But let me tell you what a Bitcoin is, and you can judge for yourself whether it's a good inflation hedge or not. So what is Bitcoin? Well, the best way to think about Bitcoin is it's sort of like digital gold. And in fact, all the language around Bitcoin is built around mining gold. Right? And so there is actually a mining aspect of Bitcoin. To create a Bitcoin, you have to buy a supercomputer, and it takes weeks, if not months, to run the supercomputer to solve a very complicated math equation. Essentially, you're looking for a very large prime number, and when you find a prime number, you're awarded a Bitcoin. Right? Bitcoin's capped at 22 million. So, when all 22 million has been mined, that's all the Bitcoins there'll ever be. So you can think of this as a new country emerging, perhaps, a new country gain independence and decide to issue currency and constitutionally say, we will only issue 22 million units of our new currency. Well, that sounds sensible, and we're probably happy to hold some of that country's currency, given that they won't print currency. We might even expect that currency to gradually appreciate in value versus global currencies. Now let's talk about the reality of Bitcoin from the theory. Bitcoin, from when it first was launched, it used to cost 30 Bitcoins to buy a pizza. So that was about 10 years ago. Today, a Bitcoin is worth about 50,000 US dollars. So you could buy actually 3,000 pizza with a Bitcoin. So this is a currency that has created structural deflation. And think of an economy where prices would have to decline by 3,000 times, as the currency creates structural deflation. Now, that's not the oddest part about that currency. It is that the currency now is worth about $1 trillion in total. And so somewhere we have decided to give to a bunch of computer engineers $1 trillion in claims to global consumption. And what have they produced? They bought supercomputers, not to do anything terribly useful, but they've burned up enough coal and fossil fuel and energy usage that are estimated to be larger than most small countries in the world. So it's actually a very non-green activity in mining Bitcoin. So not all that different versus actually mining mineral and gold out of the ground. Now, the interesting thing is Bitcoin itself has no other use. Gold, at least, is good for jewelry. Bitcoin, actually, you can't see it, you can't touch it. When you own it, it's really digitally, so you're not quite sure where it is. And you can't really actually buy stuff with it. That makes it a really weird currency. Today, you can't really buy anything with Bitcoin. You can only convert Bitcoin into US dollars and look at prices quoted in US dollars or British pounds, and then consume in the proper local currency. So that makes it a weird currency in the sense that you can't actually buy anything with it. So really, most economists agree that it is at best a very cool digital collectible. Right? You can collect this thing called Bitcoin that you can't really hang on your wall, but there are only 22 million of it available. And so you can be one of the lucky few many, many, many years from now to claim as having a Bitcoin. And incidentally, to give you a sense of 22 million, how rare is that as a rare collectible? A famous Japanese baseball player, Ichiro Suzuki, I think he's the all-time hit king, right? He's gathered 7,000 career hits. His rookie card, there were 20 million rookie cards for this player minted. And today it trades on eBay for about $5. So that's kind of like a rare collectible with 20 million limited circulation is worth today. Again, judge for yourself whether Bitcoin is overvalued or not. But then we move on to the next example. So you can't really have a polite conversation today without speculating on GameStop and understanding what that's all about. So GameStop, as an actual company, is a dying brick and mortar business. They sell used games and used game consoles. So they're not into the cool, online games and online downloading and streaming. It's a brick and mortar store. You walk in there and you can buy and trade used games. Now, at the beginning of the saga, it was trading at $2 a share because the company could very much go into bankruptcy. Gradually drifted to $20 a share as a few buyers decided to speculate on the possibility of a turnaround. And then from 20, it jumped all the way to 480 in almost the course of 2 days, based on a thesis that they're short players who believe the company is overvalued and the shorted stock at 20. And so a short squeeze was put into play and drove the stock into 480. So I'll dispense with the technicality of what a short squeeze is. But let me just tell you, at $480 a share, GameStop was at one point trading at a higher market capitalization than Sumitomo Financial Group, which is the biggest banking insurance conglomerate in Japan, as a business that's about to go out of business selling used games. Now, at the core of this is what Dom referred to as the Reddit forum. Wall Street Bet is the sub forum that's been talking about speculative stocks that people can go YOLO their life saving into, and that's essentially what happened. Right? They have decided that this is going to be the Main Street's revenge against Wall Street by going into a stock that everyone thought was going out of business, driving up to the moon, and blowing out hedge funds. And indeed, two hedge funds lost a significant amount of money, about $4 billion each, as they were short squeezed as price went from 20 to 480. But the victory was quite temporary, because just as soon as Main Street declared victory, price went from 400 back to 40. In that process, Main Street, in this revolt, lost about $36 billion. $36 billion evaporated over the course of about a week. Now, to give you a sense of how professional the Wall Street Bet chat room is, this is the welcome message if you try to sign up and to learn all about what they do. So the welcome message says, this is a forum where we, technical language here, shitpost and YOLO our life-saving away to nothing. Now, since yesterday, GameStop had come back into the news again. It's gone from $40 to $200 overnight trading. So we'll see where it opens up today. And this is all based on news that its CFO has decided to quit. So when they were interviewed, when a buyer of GameStop was interviewed for how is that a sensible reaction to the CFO of a public listed company quitting, right? Why is it that you buy shares on that day and drive it up to $200? The individual says, it's because I can stay retarded longer than you can stay solid. Since we're talking about speculative retail individuals, let me talk about a very cool index that has recently been discovered and popularized. In fact, there are two indices. One is called the Guru Index, and one is the Retail Index. The Guru Index are basically the top positions held by some of the most successful hedge funds. And the Retail Index are, of course, the stocks most widely held and traded at the retail brokerage. Now, we know, according to academic research, historically, retail individuals do quite a bit of self-harming and lose quite a bit of money. So you're not surprised that over time, when you compare the two indices, the Guru Index beat the Retail Index handedly. Right? You certainly want to invest with the Guru Index and not track the Retail Index. Right? And that makes sense, right? In an efficient market, disciplined, experienced investors are supposed to do better. But not 2020, and certainly hasn't been for 2021. Very well-known managers, whether quantitative, systematic, or traditional stock picking. The well-known ones, you have Bridgewater, who's been down as bad as 30% of the last 12 months. You have AQR, one of the most well-known American quant shop, their flagship absolute return fund being down 25%. Probably the best-known manager, Simons of Renaissance Technology, the flagship institutional funds down 30%, and Jim Simons reportedly stepping down as chairman this year. So, if the retail is winning and institutions are losing, do we expect that to persist? I don't know. It's hard to say. But certainly, in the meantime, as I go around my daily businesses, I realize that everyone who has been YOLO and all in Tesla and Bitcoin, they certainly believe they are the new Warren Buffetts, right? And anytime I hear that, I get a little concerned. Now, of course, where did all these retail individuals come from? In the US, retail trading has gone from 3%. So US used to be mostly institutional to now 30%, right? A 10x increase. Where do they all come from? Well, that takes us to our next topic, the Robinhood Trading App. Now, if you haven't downloaded the Robinhood Trading App, you might want to take a look. There's not an advertise for them, but this is simply to tell you there's now a trading platform that allows you to trade for free. Now, we know there shouldn't be something as for free, right? There's never a free lunch. There's always something in the background, and oftentimes free costs a lot more. And this is exactly the case. So what exactly does Robinhood free trading do? So essentially what Robinhood does is it actually pays for all the expenses you incur when you execute a trade. Well, why is it willing to do that? Well, because it gets paid for matching your trade with an institutional trader. So why are institutions out buying retail trades? Meaning, why are they paying someone so they can get on the other side of a retail trade? Well, that's because institutions don't really want to trade against other institutions, right? If you are Goldman Sachs prop desk, what edge do you have trading against Citadel prop desk, right? You hire about the same intelligent people with the same experience. So you want a retail individual who's less likely informed about what they're buying and selling and who's more likely to make mistakes. So big Wall Street firms are paying Robinhood and say, send your retail trades to match against my trade because I know I'll be on the winning end of that trade. And this is in fact the whole business model of Robinhood. So while Robinhood advertised as helping the little guy beat Wall Street through free trading, in fact, their business model is more like helping gamblers beat casinos by providing them free shuttle rides to the casino. Incidentally, Robinhood is about to IPO at a stratospheric price in a few months. So I've given you 6 examples of 6 firms, how they're trading, their prices, and you're free to judge for yourself whether it's normal or abnormal, the prices they're trading at, and the reactions of market participants. But here are a few lessons I want you to take away from today. We've been in a market where prices are mostly driven by retail individuals, as versus say 3-4 years ago, where it's mostly driven by institutions. Yeah, it's not necessarily bad. Well, it's more likely that prices are noisier and likely they're more overvalued securities. And certainly, it's funny when people start to believe that valuation shouldn't be based on cash flow, but should be based on proximity to Elon Musk. We've been in a market where everything's gone up, and in fact, it's the most storied, most hyped stocks have gone up the most. And in the same time, retail individuals have generally outperformed mutual funds, outperformed hedge funds. And in fact, if you held a diversified, sensible portfolio that focused on fundamentals and cash flows, you would have done very, very poorly. So the question is, when doing the right thing gives you bad outcome, do you keep doing the right thing? Or is that even a right thing anymore? And that takes us to my last thought to share with you. Well, I think it feels like a bubble. I certainly have no idea how long this is going to last. The question is, do you jump in and participate? Right? What's wrong, sitting a little bit, gambling a little bit, and participate in a bubble if you get out in time? And we don't know when the bubble is going to burst. All we know is historically bubbles tend to burst. And historically, the guru index tends to wipe the floor with the retail index. We just don't know when that's going to come. In fact, I would tell you, I'm probably quite sure that Bitcoin trading at 50,000, which I think is high, might likely go to 60,000 with a very high probability just based on momentum. Now, the question is, if I jump in today, even though I know it's wrong and speculative, but I could make a quick buck, would I then convince myself once it hits 60,000 that it'll go to 100,000? And by keep lulling myself into believing that I can be lucky and that there's a greater fool, might I not then end up being that last greater fool holding the bag? And that is a question I want to leave everyone with today. Thank you.
Jason, thank you very much for your thoughts. That was fascinating. Yeah, some great analogies and some wonderful stories there. Thankfully, Robinhood isn't available in the UK yet, so we're not being offered free shuttles to the casino just yet, but I'm sure they'll get around to opening up over here fairly soon. Great, so on to our Q&A section now. And great minds think alike. So we've had a number of you who've all asked similar questions on similar themes. So Jason, the first question for you is the UK very undervalued at the moment? And are we underexposed to it?
Got it. So if you look at valuation multiples, US is certainly the most expensive, and of course has done the very best as well. So people are rightfully concerned, well, if the US is expensive and it's a meaningful part of your current portfolio, might we want to look at UK, which might be cheaper, and which is in fact cheaper. Now today, while UK is only about 13% of your portfolio for most of the Henderson Rowe portfolio, that actually represents a overweight versus a globally diversified portfolio. Again, we want to go back to the concept of why should you hold a globally diversified portfolio, and why is it that in a globally diversified portfolio for a UK investor, UK holds such little weight? First of all, it's because the global economy is actually quite large, right? UK is roughly 10% of global GDP. In fact, it's only roughly 6% of global GDP. The rest of it is dominated by the US, by China, Japan, and therefore, you have significant exposure to other countries, not because it's an overweight to the rest of the world, but it's a simple reflection that if you want to gain access to global growth, UK only drives about 6% of global growth. So at 13% of your portfolio, it does reflect the view that we think the pound sterling is cheaper and UK shares hasn't experienced as significant of a rise in price and valuation and is a good value play.
Great, thank you, Jason. Moving on to a sort of similar kind of global sort of macro question. How do you think that US-China relations will change, now that President Biden is in charge? Might we see thawing in tensions, which could be positive for global trade and growth?
Yeah. So as a investor in a globally diversified portfolio where a lot of it is US, a lot of it is Asian stocks dominated by Chinese stocks, as an investor today, it's just really important to understand the US-China dynamic. I think we're likely to see a return to conversation, and that's quite healthy because a Cold War, a trade war, is never good for anyone. It's certainly bad for investors who have exposure to both economies. And so what we hope and what we will expect to come out of this is both the US and China realize that 2019 and 2020 were horrible years. And with COVID in the backdrop, having a trade war, which restrict global trading, which restrict exchange in commerce and value, is just bad news for everyone. So I think people are going to come back to the negotiation table, looking for a face-saving win-win outcome that will, I think, resolve the logjam. So I'm positive, and I think most commentators on that front tend to be positive about the U.S.-China relation going forward. But it's never going to be easy because China is emerging. As it emerged, and both renminbi challenging the dollar for dominance, and China becoming a larger and larger trade partner with the rest of the world, there's just going to be more conflict. And it's a conflict we've seen before. So, and I wouldn't liken it to, say, the U.S.-Russia, which is more of a ideological and military conflict. We should think of this as more like US and Japan, whereas Japan was trying to emerge, it was making the US uncomfortable. And it just takes a bit of getting used to, and the friction while they're getting used to each other were uncomfortable and created minor bumps along the way. And ultimately, what you saw was both the rise of Japan and US accommodating that rise was very healthy. And it was good for everyone considered, including satellite economies, trading and working with the US and Japan. So that's what I forecast, which is a co-opetition that occasionally will have strong rhetorics out of political needs, but generally a healthy rise of China that creates more global diversification in terms of trades and capital markets.
Yeah, excellent. Thanks for that, Jason. It's certainly refreshing, at least, not to have to be studying President's Twitter feed every day for exactly what's going on there. So that's also a positive. On to our third question, which kind of relates to something we were talking earlier about, the kind of GameStop saga. It seems that after that, Reddit and other social traders turned their attention to silver. They've alleged that bullion banks are manipulating the silver market, and as such, there's ripe for another short squeeze. Do you see this as a risk to the world economy?
So first of all, Reddit's analysis of Wall Street and the world tends to be very much conspiracy theory, right? They always have to find a evil wrongdoer, and then there's this popular uprising against what's wrong with the system. If you read people who's been posting, you realize there are a lot of very smart, but ultimately, teenage young engineers who obviously very good in their profession, but perhaps don't know very much about economy and politics. So you can ignore probably most of that conspiracy theory, and you can just take a look at the results, right? They try to make a run at silver, and we saw silver popping up by nearly 20% overnight. But it was very short-lived, and silver prices revert back to where it was nearly immediately. And if you just look at silver production, silver storage globally, it is just too large of a precious metal market, very liquidly traded because of all the derivatives, futures contract included, for anyone to really manipulate the price and to corner it.
Excellent. Thanks for that, Jason. We'll just have to wait for the Wolf of Wall Street style film of the Wall Street bets to hit our cinemas next year. We've got 3 questions left in about 20 minutes to go. These are quite sort of inflation sort of focused, I guess. Question here from Bill Johnston, which is, there is a law of diminishing returns. The banking crises of 2008 took billions to solve. The pandemic crisis of 2020 will take trillions to solve. There are only so many goods and services around to mop this money up without inflation. The conditions for deflation are gone as a result of automation, Chinese labor, low interest rates, and higher mechanization due to technical innovation. In 2008, the result was asset appreciation. This time, it's my view that whilst there will be some spillover into asset appreciation, it cannot mop up the vast quantities of money now in the world's balance sheets. What are your views as to what the best way to protect the purchasing power of our funds are, and what steps are Henderson Rowe taking in this direction?
So absolutely. The global governments are printing a record amount of money. And when they're not printing records amount of money, they're actually printing a substantial amount of money. So a crisis just allowed them to print more. And you shouldn't be surprised, and you shouldn't expect that to change, because if you think about central banks and the governments they represent, governments owe a lot of money. When you owe a lot of money, the best thing to do is to have very low inflation. Have very low interest rate that's lower than inflation, and you can achieve that by keep printing money, because that creates inflation in the background. And while printing money and holding rates down, government gets to refinance itself cheaply. So this is just a way of what we call monetizing the debt away, or put it in layman's terms, eroding government debt away. And so it's just a net transfer from all of us who hold a savings account back to the government. So you can think of this printing of money, having inflation higher than the interest rate, is another form of wealth tax. And that's been going on forever. Just whenever the government has a good excuse, it'll do so to a larger degree because we don't notice and therefore don't complain too vigorously about it. So you're absolutely right to be fearful of that, to be afraid of that. While it's not guaranteed that you'll see inflation, let's say in normal CPI as how it's measured, and there's some fudging and cheating going on there, but you are going to see inflation in asset prices, and you're not surprised to see the stock market rallying despite the real economy doing very poorly. And part of that really reflects when there's so much money, it has to go somewhere, right? It hasn't gone into consumption because we haven't been able to consume. So normal prices haven't gone up. So it going somewhere means it's gone into property prices more globally, especially in the US and Asia. It's gone, of course, into financial prices, be it in Bitcoin or the rest of the broad market. The question is, well, what can you do? Well, first of all, you got to avoid holding low interest bearing assets. So basically your normal fixed income savings accounts are, unlikely to be attractive long-term plays. For short-term liquidity needs, absolutely, you have to have some of that. For defensive risk measurement, absolutely, having some of that helps. But in terms of a long-term play, they're not the ideal assets for generating return. They're really a safety asset. And for the long-term play, you got to focus on what are the assets that give you the most structural linkage to this backdrop of inflation that will occur for the foreseeable future. And I think anything that's hard asset, so the popularity of gold and real estate are not unwarranted. What's unwarranted, of course, is if you go from hard assets into, say, Bitcoin at exorbitant prices. Obviously, buying anything that has actual cash flow that will grow with inflation. So think of companies that have a real business, and as inflation increases, they can charge more, so their revenue will outpace inflation. So firms with that pricing ability, with strong cash flow, are certainly what will give you the long-term inflation hedge. And these are obviously a big part of the Henderson Rowe management, right? When we look at companies, cash flow is incredibly important. When we look at companies and understanding macroeconomics, we also know that you want to underweight fixed income because that's no longer a return producing asset. And you only go into fixed income when there's sort of tactical view about de-risking one's portfolio. And so these are all the things that's already being reflected in your portfolio in the way we think about inflation and the dynamics of government printing more money.
Great, Jason. Thanks very much for that. And what would you do if you were sitting on cash at the moment?
Well, if you're sitting on cash at the moment, you might have a belief that things are too expensive, and the bubble might pop, and then that's a reasonable belief. Right? A lot of experts out there believe that, and I think you would be on the right side, as Warren Buffett certainly thinks so. But you have to be emotionally prepared to watch the market continue to rally away from you, and to go to cocktail parties and hear your friends talk about they bought Bitcoin at 30,000 and now it's going to 60,000. Because if you can't, be okay with that and simply say, hey, I'm just going to sit this one out, you're likely to jump back into the most speculative assets. Maybe you Bitcoin at 100,000, right? Maybe Tesla, when it crosses $1,000 a share and its value of 1.5 trillion. And that would be the worst outcome. So there's nothing wrong being in cash if that is the right risk attitude you have. But what we often see is people who are market timing for the market to collapse. They don't actually have sort of the emotional fortitude to withstand a irrational bull market rally, and they jump in at precisely the wrong time. And so that would be my only fear. Otherwise, holding in cash isn't a crazy thing to do right now.
Thanks, Jason. I guess the one part of life at the moment is no one's really going to cocktail parties, so you're sort of missing out on these conversations where you're listening to your friends who've sort of made sort of huge returns. And Jason, final question for you. If people have been paying down debt for the last year, how does this bode for increased spending and therefore equity markets?
Yeah, so paying down debt in an environment where interest rate is low is probably not the wisest, at least portfolio choice one could make. You should refinance your debt to go from high interest rate mortgage down to lower interest rate mortgage, and you should replace your credit card debt and student loan debt with maybe a line of credit against your house. Refinancing to lower rates is absolutely the right thing, and to fund your consumption, maybe even increase your consumption at a time when that will help the economy. Those would be sensible things to do. So the fact that we're observing in the UK this reduction in household debt, which automatically translate into a reduction in consumption, which then automatically translate into a slower recovery or perhaps a non-recovery, that is worrisome, right? This is the kind of death spiral cycle we observe in Japan that's gone on for the last nearly 40 years now, right? After the large real estate bubble in Japan, households were so afraid of debt, right? Because that was the biggest cause of the housing market collapse. Everyone also went from too much debt to no debt, and in that process essentially completely killed off consumption, and in that process killed off many corporations and driven such a risk averse attitude even at the corporate level that no firms have since then really invested to increase R&D, increase better product offerings, and has resulted really in a fairly stagnant economy the last 40 years in Japan. So that would be the one thing that I certainly don't want to see for the UK. And hopefully UK policymakers have learned that lesson from watching Japan and would pursue a more aggressive stimulus policy to drive an outcome that's significantly different from Japan.
Yeah, absolutely. And we've got a sort of budget statement coming out next week, which should be very interesting to see what policymakers do announce there. Well, Jason, thank you very much for your time today and for giving us such detailed answers. That's really helpful, and I think the sort of institutional perspective you bring to all the questions is really valuable. So thanks very much.
Thanks, Dom, and thank you all for coming to our virtual investor lunch.
Yeah, absolutely. Thank you so much for joining us today. If you'd like to continue the discussion, or if any of the topics have piqued your interest, please get in touch with your investment manager, and they can set up a call with Jason. And we look forward to seeing you all in person, hopefully in the not too distant future. All right, thanks very much. Bye-bye.